Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. We're so glad you joined us. My name is J. Darren Gross. I'm a real estate investor and a commercial property insurance broker. I've been an insurance broker for 25 plus years. My primary client is and has been real estate professionals. Based on this, I'm continually looking for more information about real estate investing for both my own investments as well as so I can better serve my customers. The result of these efforts has led to the creation of Commercial Real Estate Pro Network and CREPN Radio. My goal is to have and share a conversation with experts on topics of interest to commercial real estate professionals and investors. You can find us if you go to your search engine and search Commercial Real Estate Pro Network. We have a Facebook page, a YouTube channel, a LinkedIn group. If you're on LinkedIn, check us out, Commercial Real Estate Pro Network. It's a great place to network with other real estate professionals. We've got our Twitter handle at CRE Pro Network, and you can also find us on the iTunes podcast network at Commercial Real Estate Pro Network. And don't forget commercialrealestatepronetwork.com. We hope you'll like, share, comment, and follow us on one of those platforms there. All right, now that you know a little bit about us, it's time to set up for today's program. Earlier today, I had the opportunity to speak with John Wilhoit Jr. He's the president of Wilhoit Investment Network, LLC, also known as WIN, LLC. He's an owner and an asset manager of apartments, condominiums, and townhomes. His career is focused on high-volume, large-scale multifamily communities, including market-rate and mixed finance developments. He's the author of 2 books, How to Read a Rent Roll and Multifamily Insight Volume 1. He's previously held positions with the U.S. Department of Housing and Urban Development, HUD. He's been with the Apartment Investment Management Company, AIMCO, and with the Maryland Housing Fund. He's uniquely qualified to talk with us about the multifamily marketplace and the opportunities and the characteristics of each. So here's my interview with John Wilhoit Jr. Our guest today is John Wilhoit Jr. He's the president of Wilhoit Investment Network, and he's an owner and an investor and an asset manager, and just a ton of experience with multifamily, and we're so glad to have him. John, welcome to the program.
Thank you, Darren. Happy to be here.
You know, your background, like I said, it speaks volumes about experience. I was wondering if you could share with the audience a little bit about your path and some of the positions you've held.
Sure. And for better or worse, I have a very narrow lane, which is, sometimes good, sometimes bad, right? If you're only invested in the stock market, that can be a grand thing, but it also has significant pitfalls. So for me in my career track, I've stayed almost exclusively in multifamily for my entire career, but starting at probably age 30, and I'm over 50 now, so just multifamily and multifamily only for the last 20 plus years. So I started out of college buying and selling homes, flipping homes, which was great, except I was too young to know that you have to keep the cash that you earn, not just spend it. So, but that comes with experience, right, and time. And then I grew up in Southern California, so there was a vast differential in the haves and have-nots. It hasn't changed today. So even back in the 80s, $200,000 houses were the norm, whereas across the country today, right, the average price of a house is $200,000, whereas probably between 2 and 2.5 times that amount on the coast, particularly in Southern California. So it wasn't a market I could play in and continue to buy and sell. So I decided to get more educated. So I finished my 4-year degree at Pepperdine. And then a few years later, I went to Alabama A&M and got a master's in urban and regional planning. And that kind of set me on a track to do more what I would call corporate work. So I started with the Maryland Housing Fund doing tax credit asset management and dispositions and workouts. And then I moved from there to NCHP, which at the time was the largest owner of tax credit deals. in the country. And NCHP was purchased by AIMCO, and AIMCO was a roll-up REIT that ended up with more than 400,000 units. So I did asset management there for a period of time, and then I took a position with HUD doing Hope 6 deals, which were in essence mixed finance. It was a measure of private sector financing with public sector rules and regulations, and some funding that came along with it. So they were really the largest deals that HUD was doing at the time across the country, where they'd come in, with a 200 to 400 unit plan to redevelop or replace existing dilapidated public housing with something that was better. And what was better was the capacity or the ability to have what we call mixed finance deals. So not only did they have public sector and private sector funding, but they were developments that allowed not just low-income people, but allowed people of all incomes to live in the same place, which is the same as it was for us before the 70s anyway, or before the 60s, 1960s, when neighborhoods had people of all incomes in the same neighborhood, right? I mean, there wasn't the same level of economic segregation that we've experienced in my lifetime. But that was an attempt and an opportunity to build neighborhoods with incomes and people from the entire array of our society, versus trying to put poor people here, middle class people here, and wealthy people here.
Right. It's funny you mentioned that whole kind of affordable housing thing. I'm reading more and more that the problem is a growing one. It hasn't gone away, and there's talk just amongst. I know here in Portland, where I live, there's kind of a thread of conversation about the need for additional affordable housing, and I know I've read about it down in California as well. So it's clearly an ongoing a struggle to balance the marketplace or the housing with the demands and those who can afford a place to live.
Yeah, and without getting political, I mean, that's part of where the minimum wage story comes in, right? So how can someone making $8 an hour afford to rent, much less purchase in a standard suburban neighborhood? You need 2 or 3 incomes at that level, right? And we don't expect people to work 80 and 90 hours a week just so that they can afford a roof over their head. So we'll note more and more in the future that housing will become a larger percentage of people's income, as has medical expenses become a larger percentage. So these are things we must have, right? We must have food, shelter, water, medical attention, but all of those are becoming a larger percentage of Mr. and Mrs. Suburban's lifestyle. I don't have a solution. I just recognize that it's harder to become a homeowner. Certainly, rents are rising, and that will only squeeze out other things from people's discretionary income.
Right. No, agreed, and I don't have a solution either. I just know that it's a conversation that's not going to go away.
Yeah.
Well, your experience, first, it speaks volumes to kind of the topic I wanted to get into today, and again, I appreciate you taking the time to join us today. One of the things that I see and I read and there's always talk of the rent increases, or the vacancy rates are so low, or the construction of multifamily, and I think that sometimes what happens is what gets lost in that conversation when you're reading it is an understanding of the marketplace and the differentiation between the different marketplaces. Speaking to the primary versus secondary versus tertiary market. And I was hoping we could get into a conversation and talk about the characteristics and the opportunities within each of those, and go from there.
I've kind of segregated the conversation into 2 segments for us. One of them is the where, and the other is the what. So, or the people and the place is a better way of putting it. But let me just share with your audience for just a moment. So when you're listening to us here, what's in it for you, right? Everybody wants to know, why should we take the next amount of time and listen to these two guys talk. And for this particular conversation, I have many a reason why you should listen to me here. And primary one is I've had the opportunity to work on and work in developments all over the United States. So I've lived in both Washington, D.C. and Los Angeles. I've lived in New Orleans. I've spent a significant amount of time in Chicago, in the Northwest, and also in the Southeast as a professional working on multifamily deals and developments all over the country. And I've seen deals that were developed by nuns and deals that were developed by hedge funds, and sometimes you can't tell the difference, frankly, based on the level of administration. But I've really been all across this country, from small markets as small as Paducah, Kentucky, to larger deals where, for example, we were talking about affordable housing. Today's date, an affordable housing deal in Chicago may cost upward of $250,000 per unit, yet we call that an affordable deal. So when we're talking about markets, there is certainly a significant distinction between markets, and like politics, all markets are local, but they do have certain things that run through no matter the size. And it's the same with the people, right? You'll find people of means in the smallest of cities, and certainly, of course, in the larger 24-hour cities. So let me just start by saying that no matter where you live, if you are an investor in real estate, it's imperative that you have an understanding of your local marketplace, right? Presuming we're making the presumption at the moment that that's the place you intend to invest. Right. So if it's your local market, I wrote an article 4 or 5 years ago, Darren, that's still one that brings me smiles and grief at the same time. It's entitled "Your Home is Not Real Estate," and boy, did I get a lot of backlash on that. Of course, my home was real estate. Well, if it's real estate, that's quite true, but too many people anticipate or expect or believe that their house is an investment also, right?
Right.
I mean, it's real estate, it's investment, but yet if you look at it that way, and let's say that things are going poorly and you have to sell your investments to recover, is your house yet still an investment? I mean, certainly it has the attributes of being real estate. It has attributes of being an investment, but you're not going to put it into the investment category of, all right, if we have to sell some stuff, why don't we consider selling our house first or second or third? It's very likely at the end of the list, right? You're not going to touch
shelter.
That because it's not just an investment. Yeah, right. You have to have shelter. So it's an investment, and you sell it, and then what? You have to start over. You have to find another place for you, your family, and your stuff. So although it has attributes of being an investment, it's really not an investment. It's really not real estate. It's your home. Right. So it could be that. It certainly could be if it's in your will and it's transitioning into your estate. That's a whole different matter. But as a living, breathing person, your home is real estate, maybe. An investment, hopefully not, because we don't want to rely on it for a return, right, or for income. So if you're not relying on it for a return or income, how can it be an investment? Right. Anyway, that was a sidebar too, going back into these markets. But let's talk a little bit about the people in these markets. So the markets are distinguished by size, and the size has a lot to do with how many people reside in that market. So we have our 24-hour cities, but we really have what we call primary markets. And primary markets in the United States are those markets that everybody knows. They are, those cities that we use with a 3-letter tagline for the airport, right? I mean, right. Everybody knows where BWI is, where O'Hare. We don't even have to say the name of the city for people to know where these primary markets are. So there's about 30 of them in the United States. All of them have more than 1 million people in the what we call MSA, Metropolitan Statistical Area. So these large markets, they've got sports teams, and if you and I, Darren, were in Portland and I said, hey, let's go to Olive Garden, your first question might be, which one? Right? Because there's more than one Olive Garden in Portland. So these are their primary markets. So everybody doesn't live in a primary market, though. Many of our listeners here do not live in a primary market. Right. So although those get the majority of the attention, And when we think about the northeastern corridor and the southeast, perhaps that's where the majority of people reside. But yet then there's everybody else. So we can start to make a delineation from primary markets being our largest, most well-defined markets, and then move on from there. So that's where we're going to go from here. So from primary markets, the next tier of market is what we call 24-hour cities. So New Orleans is a perfect example. It may or may not be a primary market. It may not have 1 million people, but it is certainly a 24-hour city, right? You don't go to New Orleans as a visitor very likely and expect to sleep any more than you do in Las Vegas. I mean, you may get a few winks in, but you're there to do more than just go to your meeting and get back on a plane. If you have an opportunity, there's other things to do every hour. The same in Atlanta, the same in Chicago, same in Miami, San Francisco. You know, these are all places that are 24-hour cities. So what happens in markets across the country is the investment criterion and the management vertigo that happens starts in our primary markets, but yet it emanates from our 24-hour cities. So the things that you start to see in Bloomington and in Alexandria, Louisiana, very often, whatever management techniques are being deployed there or investments are being deployed there started in one of these larger markets. And then they trickle down to the smaller markets, and we'll get into what the smaller markets are in a moment. But you know, there's an old joke about, you know, whatever happens on the West Coast, people in Nebraska and Missouri know about it 10 years later.
Right.
And, you know, it's not necessarily true based on the speed of information, but I can tell you in the Midwest, outside of the primary market city here, which is Chicago, rent growth is not something that we talk about. It really, and we're talking in 2015, right, going into 2016.
Yep.
And if you were to exclusively read the headline news of the coastal newspapers, you would think that every market is going great guns.
Exactly.
But I own and operate assets where rents are still less than $1 per square foot.
Wow.
And this is now. And that doesn't resonate. That doesn't connect. People can't process that if your only market exposure is Oakland. If your only market exposure is Miami. What do you mean rents are less than $1 a square foot? There's no way. That's not possible. Well, when we start to look at median income, you can see why that occurs, right? Because even though there's higher levels of employment today, there's not necessarily higher levels of income, nor do we have any inflationary pressure, right? So every market isn't the same as every other market. Every market is local. But we started with primary markets. The next market to delineate into is the 24-hour cities. And those two types of markets drives the type of operational occurrences that happen in the next set of markets that we're talking about. So if you're looking at a primary market, 1 million people or higher, then the next tier are 24-hour cities, which may or may not be more than 1 million, but yet they're still 24-hour cities. There's a lot of expertise, a lot of energy, a lot going on in those places. But then when we leave the 24-hour cities, the next ring are what we call secondary markets. So secondary markets are smaller than primary markets, but with similar synergies, but just based on the size of the population. So, for example, I live outside of St. Louis. St. Louis proper doesn't quite have, it's less than 500,000 people in the city, but the MSA is over 1 million people. But I live an hour and a half from St. Louis. So if I want to catch a plane, there's 2 flights a day out of my city, but there's 24 flights a day, you know, from Chicago to Dallas, et cetera, out of St. Louis, right? Far more than that, of course. But so I can fly out of my secondary market, but if I'm willing to drive an hour and 20 minutes, then I can fly to anywhere in the world from that market. So being in a secondary markets, they may have a professional sports team, but it's very likely to be a farm team. They may have a commercial airport, but it's not going to be the same size of scope as the primary market or 24-hour city. You know, Omaha would be, to me, a secondary market, even though they may have 1 million people. They have one airport. Nothing wrong with that, right? Birmingham, Alabama, Little Rock, Arkansas. These are markets that you can get to, but it may be a day trip, depending on where you're trying to fly from. So it's not that they're isolated with respect to connectivity, but their growth pattern is different. Mentality is different. The pace of change is different. And they don't act or react anything like the primary markets or 24-hour cities, because what we were talking about earlier, if you recall, is all markets are local, right? I mean, if you're looking for a bank loan in Jackson, Mississippi, and you just happen to fly in from Boston, who are you going to talk to? You don't know anybody. Or maybe you've got one connect there that will make some introductions for you, but you're not from Jackson, Mississippi. And people will sit and lunch with you and go through the paces, but you're not going to be on their radar screen as a serious potential investor until they have some time in with you, right? You're just another carpetbagger coming in to see what you can buy or sell or trade. And they've got their own set of rules. They've got their own country clubs. They've got their own 3 generations of people that have lived in this county. And that's all well and good.
Yeah, you get in that provincial kind of a marketplace there.
It's a completely different matter than going to a meeting at CBRE in downtown Los Angeles.
Right.
And there's just no comparison between the two. So, yeah, parochial is what I like to consider them. Not always. I mean, I'm not saying everyone's Catholic. I'm not using it from a religious perspective, but even in the town I live in, there's folks that have been here for the last 150 years in terms of their families. So, am I in their circle? Yes, to a small degree, but I'll never be in their circle, right? I've been here 12 years, so I'm just a newbie.
Right.
First generation, so yeah, he's okay, but we need to give him a little more time to see if maybe
season
he's
a
going to
little
settle
bit
in.
here. Yeah.
Right, a little more seasoning, yes. So primary markets, then 24-hour cities, then secondary markets, and from there, the next stanza of market is what we call a tertiary market. And these markets may have a sphere of influence from a primary or secondary city, but based on their size and distance, they are, in essence, tertiary. I mean, I've been to Dubuque, Iowa, and there's actually a Sam's Club there. There's no way there should be a Sam's Club in Dubuque, but there is. But the reason there is because there's no further shopping without going 100 miles.
Right. So,
I guess that's why the Walmart industry decided that this is a good place for a store. And I'm not mad at them, but it's very surprising that they would put a store in such a small market. But yet, look how far people have to go until they can get to a larger market. So I bet you they capture a lot of business in that small town.
Ton of business in those small towns. Yeah, that Walmart model is, I think that's kind of where they really got their legs and that kind of thing. So the characteristics, I mean, it sounds like, just to kind of summarize differentiation is obviously population, and then you can also associate that with kind of a professional sports teams and airports, and the more of those that you have, the higher up in the scale of primary, 24, secondary that you would be in, and I feel like I get it. And then tertiary obviously is beyond those secondary markets. I was wondering if we could talk a little bit about the or a couple of different things. One, the opportunities, and then also if there's anything that can drive a marketplace from one class to another. Is there is there a city that you've seen that propelled itself from a tertiary to a secondary, or a secondary to a 24-hour? Have you seen any of that?
It's let me cover the last market before we go into that, if you please. Yeah. So once beyond the tertiary market, which is markets that may have a sphere of influence from primary or secondary market, When you leave that market, you're going to what's called a frontier market. These markets are even further, of course, in terms of distance from the secondary cities, and they're even very often far in terms of distance from the tertiary markets. So here in Missouri, as an example, there's the capital city is Jefferson City, which is 50,000 persons. But going 50 miles from Jefferson City, we have an area what's called Lake of the Ozarks, or Osage Beach. And that particular market has a year-round population of about 4,000 people. But if you want medical services, you're very likely going to the capital, which is 50 miles away. Now, there's medical services in this community of 4,000, but there's not very likely going to be a specialist of sorts, right, unless there's a visiting specialist. So that's where we start to make that delineation in terms of secondary versus tertiary versus frontier city. It's not just about sports teams. It's about the synergies that come with the larger populations and the option of choice. And the choice is not just in housing, right? It's in jobs, it's in schools, it's in places of worship. And the smaller the place gets, very likely, the fewer options there are, right? I can think of small towns of 5,000 persons where the only place for breakfast is the local McDonald's, and they're happy to have it.
Right.
And, that is the only place until maybe the next stanza of places open, those that open for lunch. But if you want breakfast, you're eating at home or you're going to McDonald's, because your only other option is to leave that particular community and go to a larger community where they'll have restaurants that are open for breakfast. Completely different than being in Manhattan, right?
Yeah.
How many places can you stop for a bagel on your way to, from a hotel to an office building?
Right.
Maybe only one for a bagel, but then you'll have another one for, this, another one for this. So just a completely different perspective and pace, right? So what we were about to talk about is the pace of change. And have I seen cities that grow from one to the next? What often occurs, and I'll have to use Los Angeles as my example because I know it best, having grown up there. When you're looking at Los Angeles as a market, for example, you can see, from Santa Barbara south to San Diego, there's more than 20 million people. But there is some spacing in there. There are some areas where people are not always stacked on top of one another. But yet there's 20 million people. So if we just narrow it to Los Angeles County, there's around 10 million people in that one county. So if you're trying to make investments decisions and you say, I'm going to invest in LA, that tells me nothing, right? I don't have the foggiest clue, because you say you're going to invest in Los Angeles. And then I don't have any more information per se if you tell me you're going to invest in Los Angeles County. Because you're going to be in the Valley, San Gabriel, Pomona, Long Beach, Arcadia, LAX area. Are you going down to the South Bay? Have you made a decision to invest in West Los Angeles or the Wilshire Corridor? So saying Los Angeles or Los Angeles County doesn't tell you anything. But yet, if you look at Los Angeles from a market perspective, certainly Los Angeles, like other cities, is delineated into submarkets. Dallas, as an example, has about 37 different submarkets in it. But of those 37 different submarkets, once you start to build your criteria, you're probably only going to be looking in 4, 5, or 6 of those submarkets. So going back to Los Angeles, there's over 130 different neighborhoods in Los Angeles. And yet, even knowing that in and of itself doesn't tell me where to invest, right? Or where to consider making investments. But once we overlay the people part on top of this market part, then we're looking at the demographics of the people that live there. So using Los Angeles again, of those 130 neighborhoods, if I say I only want to invest in neighborhoods where the median income or the household income is above $65,000, well, I probably cut that in half. Right? So now I'm starting to narrow my market within my market. And you can do the same thing anywhere. Even in the smallest of places, Medford, Oregon is not very big, but yet it still has a north and a south and an east and a west. And
Right.
even if we just looked at those four segments, there's certain demographic information that will convey to us where the income is, what the average family size is, where the most employment resides. In terms of the people that live there, not that they're employed in that square, but that they are employed somewhere and bringing that income to their block or census block or part of the town. So getting the market information right, looking at the demographics, that's the next stanza after doing this 30,000 foot view that we're doing of these markets, going from primary to 24-hour, to secondary, tertiary, and frontier. Great, wonderful, good to know. But that's just the starting point of next looking at the people that reside there, who they are, what they do, what their income is, what their habits are. Apple does a great job of marketing, right? Mm-hmm. They really know their customer. Well, as a real estate investor, that's what we're talking about here. We're talking about getting to know your customer. And in essence, to a certain degree, allowing you as an investor to select who your customer will be. Just like with what I just said about, I've decided to make an investment in markets where the income is $65,000 or higher. That is a decision point that will drive other parts of your investment criterion.
No, that's a whole lot better than the random approach and not understanding, and then not understanding why you're not getting the results you thought you were going to get because you assumed the market was, like we were saying, as you read a national publication that suggests it's the whole marketplace is going hucklebuck and rents are up and vacancies are down and all that, but you buy in some market that doesn't support that. So
yeah, and reading the Wall Street Journal won't get you closer to an answer.
Right.
Yeah. I think of a story about medical waste, which is years old, and there was a story in, I think it was Houston, about medical waste showing up on the shores, from the Gulf, and it really didn't get any traction. And then a year or so later, there was medical waste that showed up on the shores of the Hudson, and it was a national story.
Right.
So, the national media doesn't do a whole lot in these secondary and tertiary markets unless, something occurs that draws them there.
Right. No, and that's not getting any better.
No.
Paper gets thinner and thinner, and consolidation there, and interesting times we're in. So the conversion or the opportunity for a marketplace to change. I look at the growth of a market, and specifically think about Portland, Oregon, which is where I'm living now. I'm from the Midwest, and it's funny you bring up Lake of the Ozarks. I actually did a year down there at Osage Beach, but grew up in Kansas. And anyway, I'm out here in Portland, Oregon. Have been for 25 years now, and the mindset, and I think it starts with kind of like a civic, the city council and the mayor, and there's some sort of a vision, if you will, and how they see the market and kind of set a pace and a path and maybe some investment and some opportunity for investors to go into a particular neighborhood and revitalize that. I'm curious, have you seen it play out to where a marketplace changes from whether it be a tertiary to secondary or secondary to primary or 24-hour? Have you seen it? We talked about everything's local. I get that, but I'm just kind of curious if that, because it seems like there's other elements in play beyond the I guess the level of the market you are or that you live in, that is associated with the rent increases, vacancies, and all that. And is it all basically, does it go back to, I guess jobs and population growth? Are kind of, if you have jobs in the area and that attracts people, that will drive demand and also opportunities? Is it that kind of a...
Well, the reason that real estate investors need to pay attention to demographics is because they change, right? And people have an opportunity. We live in a free country. You can move whenever you want, assuming you have the means to do so. So migration can and does occur, and it certainly very often, more than anything else, follows jobs. But the reason to look at the markets and to review the demographics is to see which way the trends are going, right? So in Dallas, that we talked about earlier, that has 30 plus submarkets, being around the Cotton Bowl, even though you know where the Cotton Bowl is, doesn't necessarily tell you anything about that market. But that market is very likely doesn't have a lot of residents in it, if we're looking at it from a census tract perspective. So just knowing the marker from a name perspective isn't enough to tell you if that's a viable market, right?
Right.
Being in the Garden District in New Orleans, that's all well and good, but unless and until I do the research, I really don't know if people are moving there or if people are just staying there as tourists. So what percentage of that market is rental housing? What percentage of that market is overnight housing? Even though it may be a house, it may be being used as a bed and breakfast. So with respect to cities moving from secondary to tertiary or from secondary to 24-hour cities, it doesn't happen very often. But what's occurred based on the Great Recession is, and particularly as we transition to the next generation, a lot of those people want to be closer to a central city. So the best example from recent years is that within 2 miles of, and we'll call it the county seat or the, where's the city offices? What do we call those? I'm blank for just a moment.
City Hall, I don't know.
City Hall, thank you, City Hall. So whether it's county seat or City Hall, Chicago and San Francisco are two examples where more than 20,000 people have moved there within the last 2 years, within 2 miles of that particular marker. So why are all those people coming back into the city? And more importantly, where are they coming from? Right? If there's 20,000 more people in San Francisco down the street from City Hall, meaning within 2 miles of City Hall, where did they move from? Well, in these larger 24-hour cities, they probably moved from another ring, right, that's not very far from there. They moved from, they moved across the bridge, or they moved closer to the city center because that's where their jobs are. So the presumption that we're going to have an ever-expanding suburban or suburbia, I'm not so sure that's true anymore. I still have friends that commute an hour and a half to work in downtown D.C., but I don't know anyone under the age of 30 that's willing to do that.
Right. Now that urban core, I know, like here in Portland, they've done a pretty good job about developing the TriMet is what we call it, but it's a train system that has, I think there's about 4 or 5 legs now that can get you from west to east, north to south, and some other points. And the development along those lines has really taken off. And like you mentioned, the younger population not looking to, in many cases they don't own a car, so being close to some sort of a mass transit, cell phone, they're set. And if they can walk, get their entertainment, get their food, get to work, what more do they need?
Yeah, and that's we can see that through the rise of Zipcar. We can see that through the rise of Uber.
Yeah,
and Ford is developing it's not a line of cars, but it's a business line that allows people to use cars on demand. So, and this is an actual manufacturer of vehicles. They're not looking for someone else to do it. They're seeing the writing on the wall in reference to younger people not wanting to buy their product, but perfectly willing to rent it for an hour or for a day or for a weekend. So why should they give all that business to Hertz and Avis if they can have, spots? And they already have the locations, right? They have dealerships all over the country.
Right.
So when you look at Portland, Denver, and Minneapolis-St. Paul, those are three cities that are utilizing what you were talking about in terms of transportation districts as a springboard to bring people into the city and to create synergies in terms of businesses where the business and the transportation and the population reside in what we would call hubs. And those hubs are interconnected based on the transportation that allows you to move from one hub to another without having to own your own vehicle.
No, that's great. I'm just looking at our time here, and I know you've got a little bit of a limit on time here.
Yeah.
And I wanted to, if I can, ask you a couple of questions, not on the marketplace, but I thank you for dissecting that, because I think that's critical, again, to knowing where to go and understanding your marketplace and everything's local. That's great.
Well, and Darren, we've only covered half of my notes for our little time here, so perhaps we can
let's do it.
Revisit and continue the same conversation, but yet talk more about the people versus the markets, because it doesn't look like we're going to be able to cover both today.
No, I would love to do that, and we will definitely schedule that and make it happen, because this has been great as far as the information you're providing and providing something that you can apply to your marketplace so that you have a better understanding about your investing. I think it's great. Let me ask you this, because this is, I think, something I see a lot of people migrating from. They start out with like a single family investment. They've had it for a number of years. It's paid off, paid down, or whatever, and they're looking to get into multifamily and possibly do a 1031 exchange or something like that. If that was you, and knowing what you know now, is there a particular market you would look to go to? And I don't mean necessarily a place on the map, but I'm, again, staying with our theme today, the different marketplaces, primary, secondary, tertiary.
Well, the higher the level of population, very likely is there's a higher level of potential rent growth, right? But we can't really just make that as a blanket statement, because it has a lot to do with location, positioning, quality of the offering, competition. So it's hard to just say, yeah, we should stay in places where there's more people because there's more money there. Well, more money doesn't matter if you're in what should be an urban core, but yet there's no transportation within a mile, right? You have to walk for 25 minutes just to get to a subway or a bus stop or something. So just because it's in an urban area doesn't give it greater value based in and of itself being in an urban area. So we can't just make blanket statements about stay urban because. But what we can say is that the markets that you select are markets that you should select versus having someone else select them for you. And I think, Darren, you're aware that just this year I'm starting to do one-day seminars. And my biggest hurdle to doing these one-day seminars is, all right, what can I provide to people? What can I deliver that is actionable for them today? So we cover putting together and designing, I should say, your personal action plan. And doing a personal action plan is really part of that is determining the markets you want to be in and why, not just picking a market. So even within the markets, as we mentioned during this conversation, there's sub-markets within those markets, right? And again, we haven't had an opportunity to cover the people part of it. But if you just call up someone, and I'm not at all opposed to brokers, real estate brokers, they have a job to do, and most of them do it very well. But if you're waiting for the phone to ring for a broker to call you and say, hey, I've got a deal over here, well, that doesn't do any good if you don't already have an understanding of the market, as opposed to being proactive about it and calling your broker and saying, hey, Bill, hey, Mary, I'm looking to make an investment, and these are the 4 areas that I have an interest in making an investment in. If you have something there, please call me immediately. If it's not in those 4 areas, I don't want to know about it.
Right.
So look at the amount of time that saves. Just in that one allocation of reviewing your markets before you look for an investment. Does that make sense?
Yeah, absolutely. I mean, understanding your market is key to any kind of long-term plan and success. And I think probably most don't have a deep understanding of that when they start.
Right.
I think once you're in it and you realize you're not getting the results you had hoped for, that becomes kind of more of a lesson you learn kind of thing. But absolutely understanding that.
Well, and let me go back and answer the question you actually asked about going from single family to multifamily. And just recognize that multifamily begins with 5 units and higher.
Mm-hmm.
So, owning 3 duplexes doesn't mean you own a multifamily investment. It does if they're contiguous, though. If they're all connected, all 3 duplexes, then that is a single multifamily investment. So going from single family to multifamily, there's economies of scale that do occur, but also significant levels of management that's required and management skills that are required once you move up from single family investments to multifamily investments.
Right. No, there's definitely a different skill set there. 2 other real quick questions, and then we'll wrap up here. And this you can give me. I'll let you give me either one success or mistakes that either you've had or that you've seen people make. And I guess what I was looking for is some sort of a real estate investment mistake that you've seen somebody make. And it sounds like we basically said that right here, is that, if you don't understand your marketplace, you could make a big mistake, or a success that you've had or you've seen somebody have, that lends itself to this conversation.
Yeah, in reference to mistakes, and we have to kind of segregate out the Great Recession that's changed banking and lending, completely and forever. But myself included, we were in deals that we didn't know we were over leveraged until the market changed, right? We thought we were at a reasonable level of leverage, only to find out that no, that wasn't true. We really needed more of a cushion, even though we thought we'd done everything right. So less leverage versus more. I'm not suggesting all cash deals, but less leverage versus more. And then recognizing that property management is really an imperative. It's not an afterthought. So a lot of inexperienced people think that because they own a deal, they can manage a deal. And that's not necessarily true.
Right. No, those are good points to make. Less leverage. I think a lot of people learn that. You don't want to be all leveraged. Right.
It's under the category of who knew.
Yeah, exactly.
Yeah.
All right. Well, I know your time is limited here, and I want to again thank you for taking the time to do this. And we will circle back and do this second version to cover some more ground here. I appreciate that. Before I let you go, what's a good way for people to get in touch with you if they'd like to engage with you and possibly consider your seminars?
Yeah. I've been blogging at multifamilyinsight.net since 2010. So that's where you'll find several hundred articles, most of them written by me, related to multifamily property management, financing, market, and demographic analysis. And I occasionally throw in some opinions, try to keep those to a minimum, but we focus a lot, or almost exclusively, on multifamily. So multifamilyinsight.net. And then for this audience, my first book, which was Multifamily Insight Volume 1, How to Build Wealth, or How to Find the Right Multifamily Assets in the Right Markets, that's an ebook that we're going to provide to free for your audience. And that can be found at multifamilyinsight.net/Darren. And Darren has 2 R's, Darrin. And you do not have to provide us with your email address. Certainly, we'd be pleased to have you on our subscription list, but it's not a necessity to pick up the free ebook. So that's the best and easiest way to connect with me. There's an About page on there that has my contact information. And then our newest venture is one-day seminars that are live, not webinars, but actual in-person seminars. The next one's in Chicago, and then Atlanta, and then next year we'll be in Texas and California. But realestateinvestingseminar.net is that website. And on there, we're focusing on 4 areas that, as I mentioned earlier, really trying to make and bring actionable information to investors and potential investors. So we cover designing a personal action plan. We cover the biggest mistakes real estate buyers make. We spend a lot of time on property performance and why property management is such a necessity in making sure that your assets are performing the way they should. So that's a rollout for us, but you can find my books on Amazon, and you can always find me at multifamilyinsight.net.
All right. Well, John, thank you so much for offering that book for the listeners there. That's very generous of you and very much appreciated. Again, I'd like to thank you for joining us, and we will be back in touch with you to do a second version of this.
Great. Thank you, sir.
All right. Thanks, John. All right. That wraps up our interview with John Wilhoit Jr. I hope you enjoyed it and it was informative for you. I appreciate John providing his time and also the book giveaway he offered there at the end there. So hopefully you'll be able to take advantage of that and get some additional knowledge. As for our program, that's about it. I want to thank you again for tuning in and listening. And I want to remind you, you can find Commercial Real Estate Pro Network. You can search, whether it's beyond your Google or your search engine, Commercial Real Estate Pro Network. You'll find us. We've got our Facebook, YouTube, our LinkedIn group. Again, if you're on LinkedIn, go ahead and check out the group, Commercial Real Estate Pro Network. It's a great place to network in there with real estate professionals. We've got our Twitter handle at CRE Pro Network. If you're on Twitter, go ahead and follow us. We'll try and follow everybody back. And also, we've got our webpage, commercialrealestatepronetwork.com. I hope you'll like, follow, share, comment. We'd love to hear from you. Until next time, that's all. Thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.